Hi there and welcome. Today we're diving into a really powerful concept from Mansi Suryawanshi called the art of the gap. We're going to look at those sudden price jumps and drops in the market, but not as something to be afraid of. Instead, we'll see them as stories about human emotion and psychology. Ready? Let's get right into it.
You know that feeling, right? You pull up your charts and there it is, a huge price gap. It's like the market jumped ahead and you missed a critical piece of the puzzle. It can feel so confusing, maybe even a little scary. But what if I told you that gap isn't speaking a secret language? What if it's shouting a story loud and clear?
And this is the big idea that changes everything. So many people get bogged down memorizing dozens of chart patterns. But it's not about the patterns, it's about the people behind the patterns. You see, the market is just a giant auction, driven by two of the most powerful human emotions, fear and greed. A gap puts those emotions on full display for everyone to see. And that's where our opportunity is.
So, to understand the story, you only need to ask these three simple questions. Every single gap instantly puts somebody on the wrong side of the trade. Our job is to figure out who just got trapped in a bad position, who is feeling that stomach-sinking pain of a losing trade, and who is jumping in late, chasing the price out of a fear of missing out. If you can answer these questions, you're already halfway there.
All right, let's look at our first story. Picture this. A stock has been on a tear for days, climbing higher and higher. Everyone's feeling great. And then it gaps up again at the open. Now the novice trader sees this and their heart starts racing with FOMO. They jump in. But the pro takes a step back and asks a different question. After all this buying, who is left to buy? This is often a huge red flag for exhaustion, a sign that the last of the buyers are in and the smart money might be heading for the exits.
So how do we handle this? Well, the number one rule is do not chase it. You have to fight that urge. The best thing you can do is just wait. Let the emotional morning dust settle for, say, 15 to 30 minutes. If the price can't hold those new highs and starts to break below the morning's low point, that's our signal. It tells us the buyers are tired. That's a potential spot to short it, betting on the price to fall back and fill the gap, or at least come back to the VWAP, which you can think of as the day's true average price.
Okay, now let's flip the script completely. Story number 2. The market's been falling, everyone's pessimistic, and lots of traders are shorting. They're betting on the price to keep dropping. Then, out of nowhere, a huge gap up. Think about what just happened. Every single one of those short sellers is instantly, painfully wrong. They're trapped. And their pain, that's pure rocket fuel for the market to go higher.
In this scenario, trying to short into that strength is like standing in front of a freight train. Why? Because all those trapped shorts have to buy back their positions to cut their losses, and all that buying just pushes the price even higher. The smart approach here is to join the move. You look to buy on any small dips or pullbacks, as long as the price is staying above its opening level. And you protect yourself by trailing your stop, which just helps lock in your profits as the price moves in your favor.
On to story number 3. This time, the market hasn't been going anywhere. It's just been stuck in a sideways grind, a state of balance. No one's really in control. Then we get a gap up. Now this one's a little trickier because the gap has broken the balance. It's like a sudden tiebreaker. But the big question is, will the market accept this new higher price?
For this one, your best tool is patience. You just have to sit back and watch what happens in that first hour. If buyers show up and the price starts to build a new base above the old range, it's a strong sign of acceptance. We could be in for a big trend day up. But if the price quickly fails and falls right back into that old familiar sideways zone, that gap was a fake out. And that's a beautiful opportunity to fade it, to bet against that failed move. Okay, story number 4. The market's been in a lovely uptrend. Everyone who bought in is feeling smart, comfortable, maybe even a little complacent. They're long and strong, and then, bam, a surprise gap down. In a single moment, every single one of those comfortable buyers is trapped, they're underwater on their position, and their comfort has turned into pure panic. Now, the first instinct for many is to think, oh, it's on sale, I should buy this dip. But that can be so dangerous. It's like trying to catch a falling knife. The panic from all those trapped longs can lead to wave after wave of selling. A much smarter play is to side with the pain. You wait for the opening range to break down, and then you look for any little bounce back up toward a level like VWAP as a gift, an opportunity to enter short and join the downtrend. Story 5 is the perfect opposite of our first story. The market has been falling hard for days. Fear is everywhere. Bears are aggressive. And then it gaps down again. This move often isn't the beginning of more pain, it's the end. It's that final moment of absolute panic, where anyone who is thinking of selling finally gives up and hits the sell button. It's a selling climax.
So you don't want to join that panic. Instead, you're on the lookout for signs that the selling is just running out of gas. If the price stops making new lows and actually manages to fight its way back above that key VWAP level, that can be a huge signal that the sellers are exhausted. This can be an amazing opportunity to be brave, go against the crowd, and buy for a nice bounce back up.
And that brings us to our last story. Just like story 3, we start in a balanced, sideways market. But this time, the price gap's down. The floor that was holding everything up has just been shattered. The balance is broken, and a new wave of bearish feeling has hit the market. And again, the only question that matters is, will the market accept these new lower prices?
And our strategy here is just like before. We wait and we watch. If the market struggles to rally and starts building value below that old support level, that's acceptance. Our plan then is to short any little pops. But if buyers rush in with force and push the price right back up into that old comfort zone, the breakdown failed. And that's our cue to fade the move, playing for a return trip to the other side of the range.
So if you only remember one thing from all of this, please let it be this. You don't trade the gap itself. The gap is just the event. The real secret, the real edge, is in trading the reaction to the gap. It's about watching how the crowd responds in those first crucial minutes and hours. That's where the truth is.
And this right here is the kind of mental checklist that pros run through constantly. They're always asking these questions. Is the market confirming this move or rejecting it? Are we seeing signs that the trap traders are being forced to liquidate? How is the price behaving around key levels like VWAP? Is that initial opening range holding strong or is it breaking? Answering these turns trading from a guess into a calculated business decision.
And to make it all super clear, here it is laid out in a simple decision matrix. You can think of this as your daily cheat sheet. For each of the 6 stories we talked about, you have a default bias, a starting hypothesis. It's not a magic bullet, of course, but it gives you a powerful framework to start your analysis every single day. Now, we've used this word fade a few times, so let's make sure we're totally clear on what it means. Fading is simply the art of betting against the crowd's initial emotional reaction. When a stock gaps up after a huge run and everyone is frantically buying, the fade trader is the one who calmly steps in and sells, betting that the emotional frenzy is actually the end of the move, not the beginning. It's a contrarian approach.
But listen, none of these stories or strategies mean a thing without this foundation. This is the real edge. It's having the patience to wait for the market to prove you right. It's knowing exactly how much you're willing to risk before you even enter a trade. It's only taking setups that can make you at least twice what you're risking. And maybe the most important professional skill of all, knowing when to just sit on your hands and do nothing because the picture isn't clear.
And that really brings us to the final most important question. It's one you have to ask yourself honestly. Are you in this for the thrill and the excitement, or are you in it for disciplined, repeatable success? Gaps bring excitement, for sure, but chasing that adrenaline rush is a quick way to empty an account. Real success comes from turning that chaos into a calm, focused, and disciplined process. The choice, as always, is yours.